Hello and welcome to today's Premium Account Market Update for June 2017. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. I have 18 years of experience in the financial services industry and a licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities. We roll through the ASX top 50 with a particular focus on FY18 earnings, the technical trends in the market, our portfolio allocation, and conclude with the short-term market outlook. We have a special offer for clients that are interested in trialling our new charting and watch list service. If you visit blog.investorsignals.com/register, you can go on there and sign up to get access to the charts and watch list that I'll be presenting in today's recording. Our primary service is still based around a model portfolio of ASX 50 stocks. We utilise options to enhance portfolio returns, and the assets remain in your name. It's under a strict investment mandate, therefore suitable for self-managed super funds. If you'd like to know more about the service, please contact me on leon@investorsignals.com. Moving straight into a graph of the US market. Up on screens the Dow Jones, and I'll jump to the NASDAQ in a moment. That was probably the most significant sort of price action we've seen in the market in Friday night in the US time. But looking at the Dow Jones, the market continues to make higher highs and higher lows, and the structure looks quite positive there. The only thing I will say is that PE valuations are expanding well ahead of probably what underlying economic trends look like. This was a little bit of a concern, so let's go to the NASDAQ and have a look at what happened there on Friday night. So we had a large move down that was largely driven from Apple, but we saw sort of Facebook, Netflix, Amazon, so some of the darling big cap tech stocks had some pretty strong levels of selling, up to sort of 4-5%. That money mostly rotated out of tech into banking stocks, so coming into the FOMC meeting on Wednesday in the US, where they'll decide on US interest rates. So as US interest rates go higher, it's perceived to help banking profits. So that explains why some of that money moved into banking shares. Let's have a look at our local market, the XJO, and then we'll start rolling through the top 50 stocks. So domestically, we've seen obviously a big correction in the Australian banks that we've been calling for a while. The mining stocks haven't done too much at all. In the case of BHP, Rio, Fortescue's really underperformed on a relative basis compared to, say, BHP and Rio, and that's meant that our index has started to sort of break down where it's taken out this recent low, and I suspect that probably what we're looking at is an area where the market struggles to move higher, and I think some level of caution needs to be applied with portfolio allocations and making sure that there's hedging in place, and in some cases strategies to profit from individual stocks on the downside. So let's have a look at how we do this. We click on watch list, we come in, select ASX top 50, click back on charts, and then begin toggling through them. So the first one, AGL. So this stock here is a little overvalued. I've suggested that investors remain cautious on AGL at 21 times earnings on a 3.5% dividend yield. I think fair value for the stock's probably closer back to around, maybe as $22 to $24. Aristocrat, this has been a really strong technical stock in the market from a momentum standpoint. At 26 times earnings on a 1.5% dividend yield, but tremendous underlying earnings growth, growing earnings at around 30 to 40%. And I expect that to slow down to something more in the order of around 20% into 18 and 19. I think the argument could be that this stock's a little expensive and due for a pullback, and we really won't consider adding this into client portfolios until we see sort of one of these algorithm buy signals on the next dip, and it may be something more like $17 to $18 is actually a good entry point for Aristocrat. Amcor, on the other hand, we continue to like this. We think that the company can deliver 5 to 8% earnings. It's relatively defensive. 20 times earnings on a 3.75% dividend yield. owning the stock and selling tight covered calls, we're still comfortable having that in client portfolios. AMP, we've been cautious on this after the earnings downgrades and the trouble that they've had in their life insurance business and in general with their advisor network numbers slipping. So we're not doing anything in AMP at the moment, and probably sort of see that more as a stock that has pressure to the downside. The Australian banking stock, so between no revenue growth, low new loan growth, the taxes that have been applied to them, and the prospect that the bad debt cycles likely to pick up for them have all sort of hit the banks at the same time. And we've seen sort of anywhere from 10 to 15% downside move in these banking names. We're probably at a point where we could see some minor support, but I think the worry here is that if the US market has a sell-off, and to keep that in context, we haven't seen a meaningful sell-off in the US really since 2000 and well, at least say 18 months, coming on close to 18 months. And the extension that the US equity markets had post-Trump being elected, there's fair to say that there's a reasonable probability that there's some profit taking. So I think sort of anything that investors are looking at here as far as trying to take advantage of a bounce in the banks, there needs to be some level of broader hedging in place in the portfolio through XJO index puts or individual stocks to try to pick up some profit on the downside of the market. But you can see there in the case of ANZ, I've just highlighted at $27 as support. I think if we see that break, you don't want to have any long exposure to ANZ in that environment. APA not doing there at the moment. ASX, continue to like this. I think it's a great business, but they're not likely to deliver anything in the way of earnings growth at 22 times earnings and a 4% dividend yield. It's a tremendous company, and if we were to see volatility pick up in equity markets over the course of this year and we saw ASX at lower levels, then I would be an advocate of adding ASX into client portfolios, but not right at the moment. Horizon, a little concerned here around the prospect of the company being able to maintain their current dividend, and at 23 times earnings on a 4% dividend yield, which I don't think will be maintained. I think there's some risks around Horizon, so we're not holding that at the moment. BHP, comfortable holding this again, but recognising those broader risks to the backdrop of the equity market. But we own it at these levels, up at around $25. I think it's an opportunity to maybe take some short-term profit, given sort of those concerns with the backdrop for equity markets. Brambles, so this is okay at these levels, 19 times earnings, 3% dividend yield, but you really need to be complementing it with a fairly tight covered call. I think at best they grow earnings at around 3 to 5%. So for us at around sort of this $10 level, it's full value, and selling tight covered calls is our preference there with Brambles. Commonwealth Bank, support there at 77.65. If we see that break below that, I think just be careful. Next level of support back down at $70. And I think the next leg down in the banks is not a function of short-term issues here in Australia. I think it'll just simply be a function of equity market momentum in the US. Computershare, this stock's extremely overvalued, 20 times earnings on a 2.5% dividend yield. Fair value, I think, is closer back to $13 in the case of Computershare. CSL, this stock we like. I think owning it at these levels and selling tight covered calls, but it's expensive. But on a relative basis to other areas of the market, I think CSL's quite attractive. In an ideal world, we'd be picking it up on a pullback to around this 118, 120 level on the next algorithm signal. So the next time we see sort of a sell-off and the buy signal on the chart there, we'll take a closer look at CSL, but certainly holding it at these levels, and we hold it in client portfolios and have complemented that with tight covered calls. Caltex is another name that we've been comfortable owning. We've been buying it at lower levels here. We've taken profit up at around $34, and then we've just started to buy back into it again late last week. At around this $31 to $32 range, we're comfortable buying it and then going out and selling covered calls to increase that cash flow from the dividend and the call option to over 10% per annum. Uh, so Fortescue, after a substantial sell-off from $7 down to around $4.70, $4.60, we're now seeing a minor bounce in these names, and we're getting a reminder of the algorithm signal here. My approach to this is, yes, it may be that we get some support here, and we do get some level of technical bounce from this level, but stop losses or broader portfolio hedging need to be put in place. Goodman Group not doing there at the moment. GPT, we've mostly taken profit on this, just looking for a pullback, back down to maybe 495, and I'd see that as maybe a reasonable buying opportunity in GPT. To put that in context, GPT's on 17 times earnings and paying a 4.8% dividend yield. Insurance Australia Group, we don't mind this. I think this is okay holding in portfolios at around 18 times earnings and a 4.25% dividend yield. The company should grow forward earnings at about 5-6%, so owning it at these levels and selling tight covered calls, again, would generating around 10 to 12% cash flow from that. IPL, I think the outlook for IPL from an earnings growth standpoint over the next 2 years is quite attractive. So in an environment where equity markets are fairly or commodities, I should say, are under pressure at the moment, IPL, if it can hold these levels around this 350 range, I think we could see it trade higher over the next year or two. James Hardie, been a little bit cautious on this just from a valuation at 25 times earnings and a 2.6% dividend yield. Our preference has been to short this stock, and whilst we again might get a minor bounce here off this support level, we think probably the stock's actually going to continue to head lower. Lendlease, we've avoided sort of too much exposure to any of these property developers. So our preference has been sort of defensive, consumer staple, healthcare, infrastructure type names. Lendlease, I think, carries a little bit too much risk, so we're avoiding exposure to that. But to put some numbers on it, it's 12 times earnings on a 4% dividend yield, and they should grow earnings maybe 8 to 10%, but there's obviously some risks around settlements if the economy hits a bit of a soft patch. Medibank Private, so we like this name. We're holding this in portfolios at 17 times earnings, 4.25% dividend yield, complement it with a covered call, generating 10 to 12% cash flow. Not looking for too much in the way of capital gain here, given that the company's not really growing revenue and profits likely to remain flat. Macquarie, not doing there at the moment. National Australia Bank, a view with all the pattern with the Aussie banks are the same. We might be sort of sitting at a point where we get a small technical bounce, but it's really hard to get aggressive on the long side of the Australian banks given the concerns there with the US market, and therefore any exposure to the banks needs to be balanced with some portfolio hedging in place at the moment. Newcrest Mining, so gold, if we do see a sell-off in US equities, the expectation is that gold performs quite well in that environment. So Newcrest is holding up all right. It's really traded sideways for the last near on 12 months. But if gold starts to break through 13,000 an ounce, we could see Newcrest pushing up towards sort of $24 to $25. So I think there's an argument that some gold exposure at this point in sort of where equity valuations are makes sense. Origin Energy, we don't mind this name. Interesting that oil prices are obviously under pressure, but natural gas is performing quite well, and Origin's a beneficiary of that. So we're happy to own Origin on a pullback to around $7 at around sort of $8 or $8.50. I think it's time to take profit on Origin. Orica, we're not doing there at the moment. Oil Search, we don't mind this, so we'll keep an eye on it. The algorithm signals sort of flagging the higher-low formation, and maybe somewhere between this $6.50 to $7 range, the stock actually finds support. Qantas, we're not there at present. QB Insurance, I don't mind this. It should do all right, providing the US raises rates on Wednesday. If for any reason they don't, I think the market might be a bit disappointed with the impact that potentially has on QBE earnings. But with this stock at 15 times earnings on a 4.5% dividend yield, management doing a share buyback, earnings growing at about 8% per annum, it actually looks pretty attractive on a sort of relative basis to the other names in the market. So I think we own some QBE, and I think it's sort of worth keeping that one on your radar. Is it Ramsay Healthcare? So we like this. We've been buying this on the pullback. We don't sort of see it as a real fast growth opportunity from here, but with any weakness, picking this stock up and maybe looking to take profit on a rally up to around $75, I think is a strategy there on Ramsay Healthcare. Rio, still a bit cautious on the iron ore plays. BHP is our preference at the moment, given the potential for them to spin off the energy assets and or get more aggressive with maybe a share buyback program, to help pacify shareholders if they don't go down the path of spinning off their energy assets. So at the moment, our overweight resource position remains BHP, but we're certainly watching Rio and very interested how iron ore prices behave if we get this sort of volatility that we're expecting in the broader equity markets. So in an ideal world, if that volatility comes through as we're anticipating and we were to see Rio maybe back at $50, we'd certainly understand the argument that that's the price to add Rio back into portfolios. South32 not doing anything there at the moment. Scentre Group, I think this is just okay as a story. Earnings maybe grow at 3%, but it's just 17 times earnings, 5.5% dividend yield. Own it, sell a very tight covered call, and you're getting 10-12% cash flow. But the argument for a major uptick in earnings is pretty limited, so I think it's a situation where the stock really probably trades between $3.90 and sort of $4.50, and I don't see it doing too much outside of that. It really just tracks sideways. Stockland's too risky, not doing there at the moment. Sonic Healthcare we like. This is one of our preferred holdings. We've owned it at lower levels here. Getting a little expensive up at $24, and it's either a situation of taking profit on the stock and buying back in on a pullback, or selling very tight covered calls. Don't see too much more upside there. To put some numbers on Sonic, it's 21 times earnings on 3.5% dividend yield. Suncorp, we're not doing anything here in Suncorp. I think we're still a little bit cautious of sort of what the banking earnings look like and how that sort of weighs on the outlook for Suncorp from a really a credit quality issue with their exposure to the Queensland development market. Sydney Airports, we don't mind this name, so we own this in portfolios, and we're collecting the dividend at the end of this month and selling covered calls into the middle of or the back half of this year. And again, turning sort of that 4.5% dividend yield into 10 to 12% cash flow. So these infrastructure names we like, as we do with Transurban. Again, owning it here and selling tight covered calls makes sense to us, even though we recognise they're at the top end of their trading ranges, but given sort of that backdrop of market volatility, I think they'll hold up okay, and generating that 10 to 12% cash flow is attractive to us. Telstra, now there's been some speculation. Goldman Sachs put a research piece out talking about the possibility of Telstra engaging in a share buyback and the potential to cancel up to 10 to 20% of their stock, and how that would underpin the dividend at that sort of 30 cent, 32, 34 cents over as a result of the cancellation of those shares. Now the stock hasn't really reacted too much to that, so that tells me that the market's not seeing that as a certainty. But again, I think compared with the risks elsewhere in the market, I'd expect Telstra to find support here, and maybe we do see it trade up to sort of 450, 475 coming into the August dividend. Treasury Wines, well, this is really a trading stock. We've been buying this at lower levels and taking profit on the rallies. The company's growing earnings at roughly 20% per annum, so it's one of the faster growth stories within the top 50 stocks. As far as going overweight or taking a large exposure to Treasury. We wouldn't be doing that until we see the next algorithm buy signal. So at this stage it's really sort of just opportunities to take small gains along the way. Wesfarmers, so Wesfarmers we're cautious of. We've seen the company make comment about them having to provide pricing discounts to compete with Woolworths. The Bunnings business is the shining light, still growing earnings at around 10%, and their expansion with Bunnings into the UK is not likely to add any profit in the near term. So the story for Wesfarmers really is it's a 5.5% dividend yield, but the company's going to struggle to really grow earnings over the next year or two. So I guess there's some question marks there as to can Wesfarmers ultimately end up sort of down at $37 to $38 in a soft market. Westfield, we don't mind this. So again, to put some numbers around this, the stock's at 19 times earnings on a 4% dividend yield. We don't see much in the way of earnings growth, maybe 3% earnings growth, but in a low interest rate environment, maybe that looks okay. Woolworths, so this is one of our preferred holdings in portfolios. So if I try to sort of summarise what we've held, so Amcor, CSL, Caltex, Insurance Australia, Medibank, Ramsay Healthcare, Sonic Healthcare, Sydney, Transurban, Telstra and Woolworths, they're really our key holdings at the moment. So Woolworths owning it here, selling the calls out to December. Again, we're getting 10 to 12% cash flow, and we see that as a relatively defensive place to be delivering returns for portfolios at the moment. Woodside comes onto the radar with this sell-off here. I think as we see it back at around $30, could provide a good buying opportunity. Not looking for it to rally up and make new highs, so expect it to run into resistance, but we're certainly not too far away from a buying opportunity there, and there we are back to the index. So the real focus at the moment, I might just switch to a graph of the XJO. So what we're looking at here, and I'll just zoom out a little to have a closer look. We're mindful that the local market's broken below the prior low there, and if it rallies back up, it's likely to find resistance between this sort of 56.90 level and 5,000, say 700 or so. It's essentially within this range here is where we're thinking that any bounce will probably be met with additional selling pressure. And when we tie that back in with what's happening in the US, if we tie that back in with what's happening here in the US and the stretched valuations, I think sort of having a defensive asset allocation in portfolios using XJO index options to hedge the portfolio and looking at put spreads within individual names to try to profit from down moves in the market all helps to insulate a portfolio against a pickup in market volatility. And the other instruments that we've been using are the inverse exchange traded funds. So to look at an example of one of those, this is the double short in the Australian market. So over the recent time when the XJOs pulled back, we started buying into this at around $16.50, and we've just taken profit at the end of last week at around $18. So that delivered a very nice return in an otherwise fairly weak market. So we've taken profit across that inverse ETF, but we've remained short the market or protected through the XJO put options. So if you'd like to know more about the Investor Signal service and how we can help to protect your portfolio and introduce you to the inverse exchange traded funds and the derivative strategies to both complement the returns with the covered calls on the blue chip stocks, and then obviously try to protect the portfolio through some put options, we'd love to have a chat with you. So you can contact me either on the O2 number on the screen or just send me an email, and happy to speak with you about your portfolio. Thank you for listening in.